for a Kenyan residency. I know most of you understand to apply, you need some seconds to have it. But the one that's a bit difficult if you are specifically a non-resident. We're dealing here, for example, a filmmaker who is not a Kenyan resident. When you're not a Kenyan resident, that's where now we have issues of immigration coming in. That's where we have that introduction from the employer. Because if you are an employee of that filmmaker or wherever it is, then you must have those kind of things being introduced. Because we don't know you. We don't know you, the immigration doesn't know you. So there are certain things that you must have. And those are some of the things that are listed there that you must have. So that for you to be actually be given, for example, for you to be registered for PIN. Because that is the identification that will be used for purposes of taxes. As I said, you can be an individual, you can be a company, you can be a partnership, but everyone must pay taxes. So even an individual must pay taxes because what happens is that you can be an employee of a filmmaker or a film agent. You can also be the film agent yourself or the filmmaker yourself. So that makes you the employer, or that can make you an employee of that film agent or film producer. So basically everyone must pay taxes because income tax, for example, is chargeable on any income that is derived or accrued from Kenya. So any income, any. So we need to be very specific. Every income is actually chargeable to tax. So that's very clear. No one is excluded. It's not like those days where we used to have MPs who were exempt from tax. You remember those posts before 2007, 2004, 2003? Remember those days when MPs used to be exempt from tax, right? Now everyone must pay taxes. That's what the Constitution, Article 210 of the Constitution says. That everyone, even if you are the president, you are not even if you are the vice president, everyone must pay taxes. And as you continue with your work, there's things that you need to understand first. As I said, you can be an employee. If you are an employee, then what happens is that the person who has employed you must ensure that that person accounts for your taxes. But again, pay as you earn, which is it's deducted by the employer directly. For those who are employees, for those who are working for that company, so the employer must deduct and they need to carry by 9 of the following month. Then there are certain things. You can give consultancies to a film agent. You can give consultancies to a film producer. Then there are taxes. Because you are earning income from whom? You are earning, the film agent or the film producer is paying you. Then the film agent or the film producer must do what we call withholding taxes. You heard about withholding taxes? Because you are earning income. The person who is paying you is the agent or the company that has contracted your service. Because you do a lot of digital content. When you do your content, you are supplying to somebody else, you are monetizing that content. When you monetize that content, then somebody else is the one who is going to pay you because of your services. And that's an income. And that's what happens is that company or whoever contracted to must withhold. If you are a resident person, you realize it's 5%. But if you are a non-resident means you are not in Kenya for more than 183 days in a year. So probably you are an American, you are an UK person who just came here to supply that content. Then it must be done at 20%. Because for that person, we don't follow them. Remember that for a Kenyan or a resident person, you will have to file returns at the end of the year. So that's how the difference comes in. Then there's what we call digital content in 2013. 2023 about digital content, where you monetize your content. Whether you're doing affiliate marketing, whether you're doing advertising, whether you're selling things online, that's what we call digital content. You've done your content, then you monetize your content. So when you monetize your content, for example, you sell it to these many corporates, then that corporate person that's paying you must withhold that 5%. Because that's an income that you're earning as a person. That's an income that your company is earning. That's an income that you are earning as an individual. So you understand how the taxes works now. The taxes is we are looking at who that income belongs to. So who that income belongs to. That's how taxation works. Who is earning that income? Then if you are a non-resident person, there are circumstances where you don't want to your money to be withdrawn in Kenya. There are those people who are non-residents who come here. They have been brought in by a filling agent, but because of taxes, for example, they don't want to give that obligation to the filling agent in Kenya. Because what needs to happen is that you need to appoint a person that we call a tax representative, a person who will help you with your taxes when you're in Kenya, because you are a non-resident person. You have only come to Kenya to shoot your video, but you are required to pay your staff, you are required to pay staff that you contracted in Kenya, you are required to pay for consultant services that you actually gotten from Kenya, and those kind of things. Sometimes you will not want the filling agent to do that, but you may appoint a tax rep. A tax rep can be somebody who is certified, a person that actually has been licensed, has been registered as a tax rep. Then, normally all of us understand that you must file your returns, right? At the end of the day, it's an important obligation everyone has, for us to know that you are actually paying your taxes, or you don't have any income that is chargeable in Kenya. Then for those, when you talk about VAT is about value added tax. Value added tax only comes in specifically, the mandate is only given to those who wish to register, those voluntary registration, but there are those who actually meet the 5 million. If you meet the 5 million threshold in a year, if your supplies will be more than 5 million in a year, 5 million and above, that's where now VAT comes in. So for those who are small companies, or those who are individuals, and you are not supplying something more than 5 million in a year, supplying means total supplies in a year, you don't cross beyond the 5 million, then you don't need to have a VAT obligation, right? You don't need to have a VAT obligation. A VAT obligation is very important for those who are supplying their services and they are below 5 million and they are actually supplying outside the country. If you are giving a service to someone who is outside the Kenya, I will advise you that you register for VAT voluntarily, because you will have what you call more of a tax benefit, because you will now be charging VAT that you are exporting at 0%, but for the things that you use to produce that film, it was charged at 16%. Then you will be able to claim the difference as a refund. Then you will be able to claim the same as a refund, because you are exporting. When you are exporting a service outside the country, you charge VAT at 0%, not 16%. So it means now when you export your video or your film outside the country and it's paid by somebody outside the Kenyan jurisdiction, then it charges 0%, because that one, the person will consume on the other side and charge at 16%. But for you, it's applying, you charge at 0%, then 0%, and then there's the inputs that were charged 16%. The difference now is when the tax a refund comes in place. But you can decide to do what you call voluntary registration. But if you don't meet the 5 million, then you are not required to register for VAT, because VAT is actually a value chain kind of a tax. It's on value addition. You don't need to. When you take your tea in the morning, remember the tea leaves are very already VAT. It has already gone, it has already been, VAT has already been applied. Now, there are certain incentives that are provided for in the Act for those who are actually dealing with a lot on filling. Remember that when you're dealing with your filling, you incur a lot of expenses. When you incur expenses, then all that expenses are actually deductible, especially for those who are dealing with filling production or filling anything you're doing as a company or as an individual. Then everything that you actually spend during that filling production is actually an allowable deduction. It's not part of what is linked to tax. So if you make a profit, for example, not a profit, you make a sale of 1 million, but you use 600,000 or 700,000 to make that filling, then what is being taxed is actually the difference, which is 400. So that's the first item there. It's actually only exclusively expended from the tax. When you are calculating your tax, you must deduct out the first, because that's expenditure, including the wages, including the travels, including the accommodations, everything, including the supplies that you purchase, everything is an expense. So you must subtract it. You make a loss if you do a film and you sell that 1 million, but you use 1.1, then there's no tax to pay. So you see the difference? There's nothing you will pay, because the expenditure exceeds what? The amount that you are making from that film. Then there is what we call investment allowance. The law actually allows that when you acquire an equipment, for example, filling mill equipment, you are allowed to deduct 100% the cost when you first use that equipment. You may get a camera, for example, or a filling mill equipment that's worth 500,000. But at the end of that year, you only do a filling that gives you 300,000. So what the law allows you that, because it's an expenditure, but this expenditure, unlike the first one, this is a capital expenditure. A capital expenditure is not allowed 100% that year. It's only allowed at the rate of 25%. But it will be allowed within 4 years, you will have claimed everything. Because this is like capital expenditure. It's not the normal expenditures that we know, like wages, purchases, and all those kind of things. Then there's something that was put in 2016. It was put in 2016 actually for those who are dealing with the filling crews. There was a provision to provide for us to bring in many people, businesses into Kenya. There was an issue where it was being brought that if you are a filling mechanic doing a business in Kenya, then you come with crews to Kenya. What happens is that when you are paying that crew, then you should not withhold at 20%. That's what was provided in 2016, just to make sure that we have so many people spending their money here. But what happened was to make sure that when they bring that 1 billion here, then they will have maybe a few crews. They will have like 3-4 actors. Then when you are paying those actors, for example, the person paying those actors, then they should not withhold at 20%. So that was an exemption to ensure that we have that business here in Kenya. But we don't see it as if it's really wanted so much right now. But I don't know how much this has been utilized in the law, but this is what it is in the law actually providing that kind of an approach for the filling actors and agents. Then for VAT, there is what we call, but this one you must get what we call a prior approval by the Kenya, by the National Treasury. So for those who are dealing with filling, we're dealing with local filling producers. If you are a local producer, you are licensed already by Kenya Filling Commission, or you already have a license by KFCB. Now, for all your services and goods that are going into that production, you are actually exempted from VAT. So you are actually exempted from VAT. I'm saying goods and services. You can either import some of those goods, or you can either, for example, equipment. If you get an equipment, you import an equipment for filling, then you get an exemption from VAT. You don't pay VAT. So you don't pay VAT. But the catch is that you must get an approval first, or a recommendation by Kenya Filling Commission. You must get a recommendation first by KFC. And that recommendation goes to National Treasury. Then National Treasury now gives KRA the approval that that person can import, or that person can purchase a local equipment, or that person can contract a certain services like travel. For example, we talk about travel, we talk about chartering even vehicles, we talk about accommodation, because those are all services that is being used by a local filling producer. So those are things that you must get first an approval, and it's exempt from VAT. So it's very wide. All the services that person will be using is the one that's exempt from VAT. Then, as my colleague has said, there are certain things that you can import. Remember that when you import anything into the country, you pay taxes. So you pay for certain things that you import in the country. I know most of us understand that when you import a vehicle, VAT is paid. When you import some filling equipment, you realize it depends on the rate. Sometimes it can be 0%, it can be 10%, it can be 25%. But you must, when you import, you must elicit what we call a clearing agent. You cannot import, you cannot create on your own. You must engage a clearing agent for anything that you import, temporary importation. So permanent importation is for those who are purchasing directly for their businesses. You import directly for use in Kenya. So which is permanent. But it's what we call temporary importation. Because sometimes there are certain equipment you may need, but you don't have it here. But you want to import it to use it for a specific period. Like for those who are coming out of the country, sometimes they come with their certain equipment. So they come with what we call a temporary importation. You must get a temporary importation. Maybe you want to use it for 3 months only, then you take it back. So that's what we call temporary importation. But it's also what we call, when you do temporary importing or filling equipment, then these are the things that you need to do. You must first get a filling license by KFCB, that's the first thing. Then secondly, you must pay an refundable fee of 1%. So you realize whichever is low, so it can be 30,000. The maximum is actually 30,000 for that equipment. It can be equipment of 1 million, it can be equipment of 500,000, but you pay that because that's more like an administrative fee because it's a process. It's not just, you're not just coming and just going through the border or coming through the ports. Then, or you can give us a security of equivalent, depending, and then you must apply to the commissioner for purposes of being granted that temporary importation. But there's also temporary exportation of equipment. Sometimes you want to fill it in a place outside Kenya. Then you want to take the equipment, you don't want to purchase an equipment in Uganda. So what happens is that there are certain things you need to